Hello student, my name is Dr. Iqbal. This is our first lecture of stock valuation, and in stock valuation we will cover the fundamental concepts that is important for you to understand the entire chapter. We will cover the fundamental symbols that will be used in this chapter, as well as the investor required return and how we calculate it. These are the topics that will be covered in the first lecture. The key points that we will discuss in this lecture is related to how investor get required return from a stock valuation. And second topic that we will cover is how stock price is depending on the future dividends and dividend growth. This is a concise chapter outline. We will learn how computation of investor required return is possible, dividend discount model, which is split it into three components: zero growth model, constant growth model, and supernormal growth model. Stock valuation means we are calculating fair value of the stock, and for this purpose we can apply different valuation techniques. The one technique which is applied in our chapter is called Gordon dividend discount model. Remember that this is not necessary that the current stock price in the market should be equal to the price that you will calculate with the help of stock valuation model. It may vary. Sometimes it might be higher than the fair value that you will calculate, or in some cases it might be lower than the price that you will calculate with the help of the stock valuation model. Student, there are two types of cash flows that investor receive if he is investing in stock. The first one is called the dividend that is received by the investor from the company, and second is the price at which he or she is willing to sell the stock in market. So whenever investor is investing in market, there are two types of return which is expected from stock. One, dividend, and the second is selling price, which might be higher than or lower than the price at which you buy it. This is a common feature that is applied all over finance, that whenever you are interested to calculate price of anything, whether you are working in stock chapter, will remain same. The price of a stock is the present value of these expected cash flows. These expected cash flows means there are two types of cash flows that you will receive. The one is the dividend that you are receiving, and second, the price that you will receive whenever you are selling the stock. If you calculate present value of these expected cash flows, then the sum of these present value will be taken as price of the stock. This is a timeline that appears and that plays a very important role in the conceptual understanding of the chapter. Zero time is taken as today. Today means generally you will assume in your mind that we are talking about Jan 1st of any year. And when we say 1 year, it means that this is appearing after 1 year, December 31st, you can take it. So one interval will be taken as 1 year, second interval will be taken as 2 years, and so on. So when we use this term P naught, it is appearing at zero time, means today. When we use D1, it means that this is appearing at the end of the first year, means one interval has been crossed. When we use D2, it means that we are talking about that two intervals has crossed from today, or 2 years has been passed. In a similar fashion, D3 and D4 will be used. It means that if I am assuming that the stockholder bought this stock at present right now and holding it for 4 years, look at how we are calculating 4 years. Then after 4 years, at the end of the fourth year, the investor will receive dividend of the fourth year, and immediately he will sell the stock. So that price will be taken as P4. Since these are quite new symbols that a student understand in this chapter, so in the coming slides, I am presenting the important symbols that will be used. So D naught will be used for current dividend. This is the dividend which is currently paid by the company, and the investor who are selling you this stock has already taken it. We will use D1 term for the dividend at the end of the year. It means that this dividend will not be received right now. This dividend will be received after 1 year. D2 will be used dividend at the end of year 2. Carefully see that if I am saying that I am receiving dividend at year 1, then we will use term D1. If I am receiving dividend year 2, then I will use term D2. In a similar way, if I am saying that I am receiving dividend at the end of year 3, then the term D3 will be applied, and so on. You can apply the similar practice for 4, 5, and 6. P naught will be used for the current price. Current price, remember, is not showing a market price. This is the fair value that you are calculating by applying a valuation technique. We can also call it intrinsic value, or we can call it fair value. Price at the end of year 1 will be taken as P1. Price at the end of year 2 will be taken P2. So you can keep it in mind that if I am talking about that price at the end of the 4th year or price at the end of the 6th year, then you can apply the similar practice over there. Term G will be used for the growth rate, the growth of the company stock prices as well as in the dividend growth. R might be used in capital term or in a smaller font depending which you are more comfortable, but the R will be used for the investor required return. Investor required return, as we discussed earlier, will be split into two components. The first one will be called dividend yield and the second one is capital gain or capital growth. The first one is dividend yield and the second one is capital gain. We use various symbols for this purpose. So carefully see, as we discussed earlier, that RI or in capital terms or in a smaller term will be used for the investor required return. And for dividend yield, the return in the form of dividend that investor receive, we use term D1 upon P naught. In previous slides, I discussed it that from where we can understand the D1 and what is the meaning of P naught. And second is student, we take capital gain. Capital gain is the difference of price at the end of year 1 and current price, and it is divided by P naught. So for the understanding of these symbols, the previous slides will play an important role. So if we get addition of these two returns, the dividend yield as well as capital gain, we can get the total return which is required by the investor or which is expected by the investor. Showing you a question for its understanding. Just assume that dividend yield that an investor receive is 8%. If it's expected to grow at a constant rate of 5%, means this dividend will grow at a rate of 5%. What must be the expected rate of return on the company stock? So what is the expected or required return uh, from the investor point of view? So whenever question is asking you to calculate expected return, you will go back to the previous slides and we discuss, and this is a data which is available. Dividend yield, as you can see right now, is 8% and the capital growth is 5%. When you apply the previous formula, so this term D1 upon P naught is representing the dividend yield, and this term P1 minus P naught upon P naught, this term is reflecting the capital growth. When you add these two one, so the first one is 8% and the second one is 5%. So the total sum will be 13%. It means that investor expected rate of return will be 13%, which can be split into two components, 8% and 5%. Now, another thing which I am trying to highlight over here is that just assume that this 5% is missing and 8% and 13% is given. So can you calculate this 5%? I hope so. In a similar fashion, if I provide you these two information that 13% is given and 5% is given and 8% is missing. Then can you calculate this 8%? Yes. Only one illustration I am showing here for your understanding. Just look at this question. Current price of a stock is 20. Expected price after 1 year is 22.5. Investor required return is 18%. What percentage of dividend should company pay? Carefully see that three informations are given in the question. Current price. So being a student of finance, you will decide what term you can apply over here, what symbol you can use over here, as we discussed in the previous slides. And then expected price after 1 year, then what symbol is practically possible over here. Then investor required return is 18%. So I'm showing you all these symbols. P naught is 20, P1 is 22.5. Investor required return is given in the question 18%. So if I apply the formula as discussed earlier, so you see that certain informations are available. These are the informations which are available in your question. Required return is given. Dividend yield or dividend percentage is missing from the question. P1, P naught and P naught is given. So if you mathematically manipulate it, so calculate this one and minus it from the 18%, so you will be able to get dividend yield. So this is the final answer, 5.5%.